Hello and welcome to lecture 4 in this lecture series on the subject of Principles of Insurance IC01. This lecture series is based on the syllabus fixed by the Insurance Institute of India in 2025 and is designed to help those who would like to watch and listen to lectures so as to understand the subject and write the exam conducted by the Insurance Institute of India. Before we begin today's lecture on how insurance works, let's do a recap of what we did on the last occasion. We saw on the last occasion that an insurance is a contract. The consideration is the premium paid by the insurer. The insurer agrees to make good losses suffered by the insured, and the loss must arise of an insured peril. Now, insurance is a formal mechanism where the insurer agrees to compensate for the losses to the insured. The premium collected from one person is always lesser than the potential loss that the insurer might suffer. This naturally leads to the question, how is it economical for the insurer? The answer lies in the pool of funds, that is the premium collected from numerous persons. The key aspect is that not every insured will suffer a loss. Only a small percentage of the insured will actually suffer a loss. A successful insurer is one who can accurately determine the percentage of insured who will suffer a loss. There is a magic formula, the law of large numbers, which forms the basis of insurance business. The law of large numbers was introduced by Jacob Bernoulli and was published posthumously in 1713. It states, as the number of trials of a random process increases, the percentage difference between the expected and the actual values goes to zero. The law of large numbers is applicable only for random events. A random event is one that is purely dependent on chance and is independent of any other event. Examples of random events are coin toss and rolling of dice. Can you predict the outcome of these events accurately, like tossing a coin or rolling a dice? No. But look at this graph. On the x-axis is the number of trials. On the y-axis is the percentage difference between the expected and the actual values. The law states that as you increase the number of trials, the difference between the actual and the predicted value goes down. Although it sounds a bit complicated, let us see a simple example of tossing a coin to understand. You can even try this at home. Assume that a coin is tossed 10 times. Let's call it n. The number of times the coin is tossed is called as n for generalization's sake. The probability of heads appearing is 50%. So, the probability of tails appearing is also 50%. When you toss the coin 10 times, it is not that exactly 5 tails and 5 heads will come. It may be 3 heads and 7 tails, or 4 heads and 6 tails, or 6 heads and 4 tails, or any other combination. It would be rare to get 10 heads or 10 tails only. Now, the law of large number says that as n increases, that is the number of trials, the actual outcome is closer to the expected outcome. This is what is depicted in the table before you. You will notice that as the number of trials increase, the actual outcome mirrors 50%. And the difference between the actual and the expected outcome reduces considerably. And goes near zero. To give an example, when n was 10, that is the number of trials was 10, the difference between the expected and the actual outcome was 10%. But when n was 10,000, the difference between the expected and the actual outcome is only 2%. Now, when n was 10 lakhs, the difference between the expected and actual outcome reduced to only 0.50%. This is a very small number. This law of large numbers is used in insurance to predict the outcomes. Even here, you see, this is just a graph of what is depicted in the table. The green line is the actual outcome and the orange line is the expected outcome. Now you see here, as the number of trials increase, it nears 1 lakh, the gap between the expected and the actual outcome considerably reduces. Insurers apply the law of large numbers by studying a large number of exposures. They use data to estimate the possibility of loss. The principle holds true. Larger the data, the closer the actual percentage of losses will be to the estimated percentage. For example, an insurer might estimate the expected outcome for a particular car model to be 4 accidents per year based on vast historical data. If the actual number of accidents is more than 4, the insurer faces higher losses. If the actual number is less than 4, the insurer might have pegged the premium too high as compared to his competitors. To get the best estimates, the insurer needs larger data and larger data for longer periods of time. Longer is the better. This is because data for shorter periods may not accurately reflect the general picture. For example, you cannot rely on accidents that happened in 2020 and 2021 because there was lockdown for considerable periods. With data generated for larger periods, outliers and special data could be moderated. Like every good thing in the world, there is a problem. The law of large number is a statistical, not a physical law, and its implementation has limitations. Therefore, it is not same across physical boundaries. The data is contextual and situational. Therefore, it cannot accurately predict the future. That's why larger and longer periods of data will give better estimates. Larger data helps, but outliers like COVID-19 pandemic or catastrophic events cannot be predicted. Relying on skewed periods like the COVID-19 period can lead to poor estimates. The scope of liability risks is also increased by consumer-friendly judgments of courts, which steeply increase the compensation for losses. This also needs to be taken into account. Prudent insurer must be aware of the limitations of using past data for future predictions. Reinsurance. A good measure to prevent losses from catastrophic events is securing reinsurance support. Relatively new insurers should use proportional reinsurance like quota share insurance, where the insurer and the reinsurer agree to share both premiums and the losses at a fixed predetermined percentage. And emerging trends. Insurance needs to keep close watch over emerging trends and update their models and estimates. External data. They should also study and determine the effect of data from other bodies and the public domain, such as road traffic, health and death records, as well as court rulings. Alternative risk transfer mechanisms. Resorting to ART mechanisms helps buffer available resources to meet contingencies. Actuarial expertise. Professionals known as actuaries who specialize in properly estimating the future using mathematical and statistical methods must be involved in estimations. Despite all safeguards, unexpected catastrophic losses should still be anticipated. The insurance company must constantly increase its capital and build up reserves to handle these underwriting shocks, as actual losses could be much higher than estimated. That's all for today's lectures. See you in the next one.